My name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about financial reporting, specifically accrual basis and cash basis financial reporting. Now, you may ask, what is that? So when you do financial reports, if you hear the term, I need P&L, because that's very important as far as determining profitability, if you want to get a loan, how much taxes you need to pay, essentially starts with a P&L or a profit and loss statement. So when those things are put together, there are two different methods to create these profit and losses P&L statements, or otherwise known as income statement. So there's two ways to do it. There is the cash basis and there's an accrual basis. And it's important to know the difference, because when you're presenting these statements to third parties, you need to know what the differences are, or know which method that you're using, because it can greatly affect the outcome of what it is that you're trying to achieve. So you would use such statements to get your taxes done. You would use such statements to get loans. If you are looking to make a sale or get an idea of the valuation of your company, this is probably one of the most important statements. So it's important to know which reporting method that you're using to make sure you get an accurate outcome of what you're looking for. So again, there's the cash basis of reporting and accrual basis of reporting. Really, the main difference between the two methods is basically timing. So it's the timing of when you bill for services versus the timing of when you actually collect the revenue for said sources. And then on the flip side, timing based upon when you actually pay a bill, and vice versa. And then on the flip side, for expenses, the difference is based upon timing as far as when you receive a bill and when you actually pay the bill. From a cash basis, everything is based upon when the cash is actually received or spent. So on the revenue side, if someone actually pays you $100, you will record the $100 in revenue. If you pay the $100, once you actually pay the $100, then you record that expense. That's essentially what cash basis is. It follows the actual flow of the cash. Now, accrual is a bit different in the sense that it accounts for cash that you are to receive. So, for example, from a revenue standpoint, if you're in the business of billing people and you get a delayed payment, so say you perform services for someone and you send them an invoice and they'll pay the invoice in 30 to 60 days. So on an accrual basis, you would report the revenue on the day you send the bill, not when you receive the cash, versus on a cash basis, you wouldn't report that revenue until you actually receive the cash. So that's one of the big differences between cash and accrual. Now, on the expense side, let's say a vendor sends you a bill and you have to pay it within 30 to 60 days. On a cash basis, you would not report that expense until you actually paid it. If you're reporting on an accrual basis, then yes, you would actually report that expense once you get the bill. So that is the main difference in a nutshell. So it's really all about when you receive the cash, when you pay out the cash. Now, it's important to know which version of profit and loss which you're using when you're doing reporting, depending upon the task at hand of what you're looking to do. So when you're doing your taxes, you work off of the cash basis. Or it's very important that you recognize or make sure that you are using the cash version of your profit and loss, because if you're using accrual and you have a business where you bill and you have outstanding invoices that you haven't been paid on yet, if your reports are in the accrual method and you use that on your taxes, you would essentially be paying taxes on money that you didn't receive yet. And from a tax basis, you don't want to do that. So you need to make sure that you're using a cash basis profit and loss statement. But when doing taxes, now with most financial reporting, if you are using this for third parties, so say if you're looking to get maybe a mortgage, maybe a company valuation, those tend to lean more towards the accrual method. if you have the accrual method, if you have a number of invoices outstanding, you're going to want to show that you're making that money. So if you have a number of outstanding invoices and that, okay, well, it's coming in, you just haven't received it yet, you want to show said lender or person evaluating the company, you would show that your company may be stronger reporting on an accrual basis than a cash basis because you have outstanding invoices that you will soon to be paid on, versus with the cash, you wouldn't be able to show that. So the lesson here is just make sure that depending upon the purpose of what you need the statements for, make sure you're just using the right version. That's all for now. If you have any questions about this topic or any other tax or account related questions, feel free to reach out. Happy to help. All right, see you on the next one.